All right, welcome back, everyone, to Retire Stronger podcast, episode 9, talking about inflation risk today. I am your host, John Foard, with my co host, Bill Kearney. Bill, how are you doing today?
John, great to see you. Great to be back with you as always.
Great. Well, let's dive right in. So, we're talking about inflation risk today, which is quite frankly, it's been quite a topic over the last 3, 4, or 5 years, especially during COVID. And it's always a topic of concern for the individuals and families and business owners that we work with. So let's just dive right in and talk about what inflation risk is. And I think we're going to go over, I don't know, a good 8 or 10 different ways that inflation risk can impact you from a long term perspective, especially as you head into retirement and you are using your hard earned savings to help supplement your retirement income. And you know, the thing about inflation that I think we're going to illustrate today and talk about a lot today is how it impacts spending and the power, the purchasing power of how your money will last you in and through retirement. So um, I will let you kind of dive in and start us off with the first topic we're going to discuss on inflation risk today.
Sure, John. Yeah, it's an important topic, not just for retirees and pre-retirees, but really for everyone, because
True.
inflation risk is one of those things that is slow moving. It eats away little by little, year after year, and many people they hardly notice this is occurring until you wake up one day and you realize you can't buy the same things you used to buy before because they become so much more expensive. Right? And so that's the erosion of the purchasing power that you referenced there. Um, on average, inflation over the last 120 years has been about 3% annually. But in the short term here, especially since COVID, we've seen a really rapid increase in inflation. And let me just give you a pretty simple way to understand inflation risk. Let's say that you're purchasing an item that's $1 and you're experiencing 5% inflation. Well, after a year, that same item is going to be $1.05 to purchase, which isn't
Correct.
that big of a deal, right? It's kind of a slow moving increase. But if you go 10 years with 5% inflation, that same $1 item is now $1.63 because of compounding, right? So in the show notes, we'll have a chart that'll give you an example of how inflation eats away at purchasing power over time on milk and on things like automobiles and that type of thing to give you an idea of how this works. And this isn't just a concern, obviously, for things that we buy, but it's also a concern on our investments. You might look and say, well, I had a 5% return on my investments, but if you're experiencing 3% inflation, then the actual return on your investments is really only 2% once you back out inflation from that. So definitely a concern for investments, definitely a concern for the things that we purchase and the things that we need. But let's talk a little bit, John, about why inflation risk matters. Why should we concern ourselves with this? Isn't this just something that we have to deal with and there's really nothing we can do about it?
Well, it is something we have to deal with, and we can do certain things about it. So it's a great question. So basically, what you're asking is why does inflation risk matter? And at the end of the day, it's just about already what you've talked about: rising costs, and especially for our clients that are retired and they're on a fixed income or they're dependent upon a fixed income or a pension or living off of Social Security. You know, these individuals can experience a compromised lifestyle, because if inflation outpaces their income, then as you already mentioned, you're going to have trouble paying for things that you used to be able to pay for because now they have increased in price to the point where it's prohibitive for you to pay for those things. And let's move away, as you mentioned before, from just retirement, and for individuals that are retired and on a fixed income, let's just talk about long-term investment growth. At the end of the day, inflation can erode the growth potential of an investment portfolio. And you mentioned it. It happens slowly over decades, or in some cases, it can happen very quickly if we go through um, rather historical inflationary periods as we witnessed during COVID, for example. And it can affect your long-term financial goals like retirement or education funding for your children or grandchildren, and just overall wealth preservation. If you have a goal of leaving a legacy to your family, that legacy can be severely impacted long term if inflation is not taken into consideration. Um, so again, cost of living, and making adjustments, inflation matters. Inflation risk can take a real toll on those things, because your cost of living expenses like food and housing and healthcare. I mean, healthcare is a big one. Tend to increase over time, meaning stagnant income in real terms can realistically can become insufficient. Bill.
Yeah,
So.
exactly. And there's there's a really long history on inflation, how it's calculated, how it's been viewed over the years. The Bureau of Labor Statistics is what tracks inflation, and they have made major modifications to the formula that they use for inflation. I think one of the biggest ones was in the mid 90s. They introduced the core inflation definition that took out food and fuel from that calculation. So we've seen kind of wild swings over history in inflation. Generally, as I said earlier, it's been historically around 3%. But in the 70s, you saw periods where it was well over 10% per year.
Yep.
More recently, we've seen some very, very high inflationary years that we've had to deal with. Um, then there's the whole concept of hyperinflation, and there's been some
Hmm.
countries, across the world that have experienced hyperinflation, which is a rapid decrease in an erosion in the purchasing power of dollars to the point where they become almost worthless for
Yep.
those companies trading in dollars. So you've got that. All of this then plays into the big impacts that inflation has on different asset classes. So, for example, let's say that you're holding cash and that cash is paying you 2% and you're in a 10% inflationary period. If you leave the money in the account earning 2%, you're going to see that your balance increases in the account. However, at the end of a year or 5 years or 10 years, while you have more money than you started with, your purchasing power is much lower than it was to start with.
Yeah.
So the
Significantly lower.
increased, yeah, the increased account now might have more money in it, but it can buy less things,
Correct.
right? Same thing with bonds and fixed income strategies. They typically suffer under inflation. There are certain bonds like TIPS, which are Treasury, the inflation protected type securities. Um, Sometimes equities can serve as a hedge against inflation. Just kind of depends on obviously how the portfolio is constructed in that type of way. I think real estate is a good one as far as something that keeps up or sometimes outpaces inflation. And then commodities like gold and silver. Oftentimes, you will see that the price of gold, the price of silver, which have increased here lately pretty quickly over time, are a direct reflection of the change in the purchasing power that you have from a U.S. dollar, for example. So oftentimes they can keep up and they tend to rise with inflation to kind of offset the impacts of that from there. And then, John, there's this whole universe of interest rates, right? And how inflation and interest rates, and let's talk for the next 3 hours here, John, if you will, on how the on how the Fed is going to help us with interest rates or the impact that they have.
Oh, the good old Fed. Yeah. So, real quick, I think it's also a great time, real quick, to remind everyone that the information we're sharing today is not, we are not sharing information as a recommendation to you. So, if you have questions about anything you hear about, on this podcast episode today, please reach out to us at info@crownadvisorgroup.com, or feel free to give us a call at 704 469 0200. So yes, let's dive into inflation and interest rates and kind of how they are intertwined. And you mentioned the Federal Reserve, and not just the Federal Reserve in the United States, but also central banks around the world and in other developed countries. Um, and they consider themselves, to be one of the major tools for helping stem inflation. and control it to the best of their ability. But typically, what happens is, you have the Federal Reserve will often raise interest rates to curb inflation. Now, while this can dampen and possibly bring down inflation, or at least pause it, and, slow it down, it also impacts the cost of borrowing. It impacts bond values. It also will impact investment yields. So, although it may help with inflation, it can also create other issues and problems elsewhere. Rising rates can lead to lower bond prices, impacting your bond portfolio values. But on the flip side of that, if you are looking to buy bonds, bonds issued at higher rates may eventually benefit investors. So there's that inverse relationship as well. And we literally could talk for hours on um, the Fed's relationship to inflation and what their mandate is. But that's a very quick hit on the Fed, because I don't want to get too bogged down on talking about the Fed in this episode today. But let's also talk about other factors. Really, Bill, there's other factors too that influence inflation. Economic policy is one. Fiscal policies, such as large government spending, can increase inflation risk, and can lead to demand that outpaces supply. Let's talk about COVID, global supply chain constraints and issues that we saw during COVID, early COVID years, like chip shortages for vehicles. I can remember having to replace a vehicle for our family, and we struggled with being able to find inventory due to supply chain issues, which drove up prices, which caused an inflationary environment with regard to how much vehicles cost. Um, I never thought in my wildest imagination that you would see used cars increase in value the way that they did during COVID, but that is results, of inflationary times due to certain things like global supply chain constraints. Um, Wage growth in the labor market. High wage growth can drive inflation as businesses pass the cost off of the labor onto consumers. So people demand to be paid more. Well, that's got to come from somewhere, and these companies will have to raise prices of their products and services in order to pay those higher wages to their employees. You already talked a little bit about commodities, but energy and commodity prices, the rising price of oil, for example, can have widespread inflationary effects because of its impact on transportation and manufacturing costs, and the list goes on and on. Again, we literally could talk for hours on different factors and influences that impact inflation risk with our clients specifically. But let's kind of move, Bill, to how do we manage inflation risk?
Yeah, and just one thing I want to cap off what you were saying. A lot of times people don't connect the dots between increased fuel costs and why is it costing more for things at the store? How are those things related? And what you have to remember is that producers, if they are charged more for the materials and the products they need to create the goods and services that you need, they're not going to just absorb those costs. I mean, they will to a certain extent. They will to the extent that they can, right? Or that it makes sense. But for the most part, that expense, that extra cost is going to be pushed onto you, and it's going to be reflected in the price tag that you see when you go to the store, right?
Absolutely.
So if you want to know, how inflation, where it starts, right, from a starting standpoint to you going to the store and seeing the difference, well, keep an eye on the price of oil, right? Everything is made with oil, whether we like it or not. Everything is made with that. And everything is generally transported to the store using that particular commodity. So that's a big one right there, as far as if you want to see what's happening or what is a leading indicator as to where inflation is going to go. Price of oil is a huge way to look at that. But John, to kind of segue here into the managing part of this, we talked a bit about diversifying portfolios, diversifying your assets. There are different types of asset classes that may be somewhat insulated from inflation, or that are particularly structured to deal with inflation, to track along with it, that type of thing. Maybe that can include things like dividend growth stocks. Oftentimes, those will help there. And again, as you said earlier, we're not making any portfolio recommendations here, just kind of giving you some ideas of, hey, it's not all a lost cause here. It's not something you just have to deal with. There are things you could do in
Right.
times of higher inflation to adjust your portfolio accordingly.
Correct. We just
I
got to
will,
plan for it.
yeah, exactly. I will say too, though, typically what happens, or oftentimes, I'll put it that way, what happens is that instead of people maybe making modifications to their portfolio to deal with inflation, oftentimes what we see, especially for people who are withdrawing funds during retirement, is they can actually move into a secondary risk from inflation, which is called excess withdrawal risk. Now,
Absolutely.
excess withdrawal risk is pretty self explanatory. It just means, hey, I'm taking out more money than my portfolio can actually withstand to live through a successful retirement. And John, I wanted to tell you just like a little illustrated story to give you a picture of how this works. All right. So John, I want you to pretend that you're stranded on an island in the Pacific with your spouse.
Okay.
All right. Now, I don't know if that's a good thing or a bad thing. That's not what the point of the story is. But let's just pretend that you're stranded on the island and you find this magic genie that will come once a day. You've got these 2 jugs of water, and the genie's going to come every day and refill your jug of water with 2 cups. Now,
Hmm.
the great thing about this is you only need 2 cups of water each day to survive. So, as long as you only drink 2 cups of water, Genie will come back each day, refill your container, and you can live happily ever after. But imagine, John, one day you wake up and your spouse falls ill. Temperature goes up. It's exceedingly hot on the island. You have to go in and you have to take out maybe an extra cup of water. You take out 3 cups or maybe 4 cups in a particular day. And you realize, you know what? The genie came back and put 2 more cups in, and the bottle's pretty much still mostly full. So you continue this process on and on until ultimately you realize you get all the way down to the end of the bottle. You've got the last few drops of water that you pour out. And the deal is with the genie is once the bottle is empty, the genie doesn't come back. Well, think about how you would feel if you got to the end of that bottle, stranded on this island in high temperatures, and you have no more water and the genie's not coming back. Well, that's exactly what happens with excess withdrawal. And inflation is generally the thing that leads people to excess withdrawal. I need more money out of the bottle of water to keep up with the erosion of my purchasing power. And I do this over and over, slightly more each year, not realizing the impact that it's having on the overall success or failure of my portfolio. So that is probably the most dramatic form or the most pertinent form of destruction that it can cause inside of a plan or a portfolio is leading towards excess withdrawal. And I know you can probably say this, John, with clients you've worked with. I can as well. I've had people come to me and say, hey, you know what? We need to draw out more funds. Can we do that? And we have to run it through a stress test to make sure that you can do it, right? To make sure that we're not putting you in peril for what you're attempting to do on your portfolio.
Absolutely. So, and I think what you're getting at is just using higher inflation assumptions in the financial models that we run for our clients. We also kind of talk about that in a terminology that we call sensitivity analysis to make sure that what the client's looking to do can you know pass muster within the portfolio and the planning process that we've completed to this point for the client. Um, yeah, these are things that have to be done. Matter of fact, I would say, Bill, that it's smart to do these things before you get to retirement to determine whether or not you would be able to withstand higher inflationary periods potentially. We typically use the higher, slightly higher than average uh, inflation rates within our financial plans with our clients, just to make sure that we plan accordingly. Um, but there's ways for us to stress test that even further if we need to, and I think it's smart to do that, and we typically do that for our clients. So that's basically what you're referring to, and again, so back to a comment you made earlier, this isn't a lost cause. It's just something that needs to be addressed, and that is how we address it, by modeling and planning. We have to account for it. It's not going away. I think that a lot of folks want prices to come down on certain things. And if that happens, we're talking about deflation, and that brings on a whole different, you know, set of issues and problems that we should be discussing and talking about if we were ever into a deflationary environment. But yeah, so let's also talk about, Bill. Like we've been talking about this the whole time during this episode, but let's just recap real quick, kind of who's most affected by inflation risk. And I would say that everyone is affected by it at all times in their life, but the people that we see that are the most impacted would probably be um, people that are retired and on a fixed income, and people who invest in fixed income. Um, so, retirees, especially those that with fixed income sources like pensions that do not have a COLA adjustment, probably feel the most impact from inflation over time. Individuals who have low risk tolerances and are investing in low return investments, low yielding assets such as CDs or savings accounts, will definitely be impacted, and we'll see significant purchasing power erosion if inflation remains high over time. And then long-term investors with no inflation hedges, those type of individuals who have long-term goals but have not diversified to include inflation hedged assets, will very much find their investments could potentially fall short of their future needs. So these are the types of individuals that are going to be impacted by inflation. And I don't know if you could tell, Bill, but we basically just described everyone, but just at different stages or possibly different risk tolerances, stages of their life and different risk tolerances for their portfolio. That is why we always preach. Again, we're not giving advice here, but we always preach that you should have some type of hedged equity scenario in your diversification of your portfolio. And, at the end of the day, if you're not planning for this, you're going to be you're going to possibly be sorry that you didn't when you get to retirement age and you're not able to continue to keep up with rising costs at the end of the day. So inflation risk, crucial factor in preserving long-term purchasing power of your investments, especially for retirees and fixed income investors. And by understanding inflation's impact on various asset classes and utilizing inflation hedging strategies, you can manage this risk and protect your financial goals over time. So, Bill, I'm going to kick it back to you. If you want to add anything else to what we just talked about, I think we've hit all the highlights of what we feel is important regarding inflation risk. But is there anything else you want to share with the audience today?
Yeah, I think the takeaway here for the person listening at home is, look, you need to contact the person that's helping you manage your plan. And you need to ask them, how is your plan going to deal, or how is it structured to deal with inflation? And you need to remember this. You can go in there with a little bit of ammunition and say, look, you're getting hit on both ends as it relates to inflation. You're getting hit on the expense part of your portfolio, right? Your household expenses, because those are increasing a little bit over time. As we mentioned earlier, it's like a slow killer over time. But you're also getting hit on the investment side. So while your expenses are increasing, your actual return on investments is probably lower than what it says on the statement, because the statement doesn't take into account inflation, right? So this is
Correct.
a double whammy. This isn't just, oh, my investments didn't do good this year, I'll look forward to next year and see how they work. This particular thing is creeping in slowly. It's kind of like you're sitting in a room and the walls in the room are slowly inching closer to the middle. That's exactly what's happening here. And at a certain point, you can't sit in that room anymore. So you have to figure out a way to deal with that.
Mm-hmm.
Both on the you're limited in how you can deal with it on the expense side, but you do have some options and tools available to you on the investment side. And I think that's where you need to begin if you're going to start somewhere and trying to tackle this, or at least just be aware of how it's impacting you.
I could not agree more. So why don't we wrap it up there, and we'll pick it up. We'll pick up our next topic on our next episode. So stay tuned. But folks, remember, we are financial planners. We do work with folks that are 40 and above that are looking for help with their retirement planning, especially on tax efficiency. So this fits right in with the type of individuals we work with. So if you have questions, feel free to email us at info@crownadvisorgroup.com. That's advisor with an OR, group.com, or call us at 704-469-0200. Again, it's a pleasure to be with you both, with you, Bill, and with all of you out there in the audience today. again, reach out if you have questions, and we'll see you the next time.
Thanks, everybody. Take care.
Take care.